You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, so as usual here on Options Playbook Radio, we start by looking at the trade that we did last week. When we have a trade, sometimes we do a huddle up, myself and Mark Longo, and talk a little bit about or answer listener questions. But last week we actually did a FOMO trade. You say it's not done well, but the market hasn't done well. The trade was on Disney, and this week we're going to actually look at how to deal with that trade, considering what happened in a short period of time. So I should let you know before we get too far along that we are taping Options Playbook Radio on Wednesday, December 7th. The markets are closed. We saw Disney today, last trade at $92.15, down a mere 14 cents on the day. But since we talked about it last week, Disney is down over 5 points at this point in time. And when we're looking at the trade, that would mean that when we were looking at the trade last week, Disney was around 97.5. All right, so here's what we looked at doing. We did a fig leaf last week. We bought a deeper in the money option contract. A lot of people have been talking about Disney, maybe looking at, trying to find that entry point. Eventually, well, a lot of the pundits right now are saying that eventually everybody's thinking Disney is a buy, that Disney is not going away anytime soon. They've had success in their Disney Plus area, but obviously the theme parks and everything else on that side of the equation has been hurting Disney, not to mention a few other things. So with that said, where is that entry point? And that's part of the reason why we looked at buying a deep in the money call option as an alternative to buying the stock outright. But because the markets are what they are at this point in time, we decided to sell a shorter term call against it, hence making the trade a fig leaf. So what we looked at doing last week was buying the April 21st, 85 strike call. Remember, the stock was around 97-ish, a little over. And then at the same time, we were looking to sell the Disney December 16th, 106 strike call. We were doing this for a net debit to the account of $17.10. But it's important to note where the long call was and the short call was. The long call at the midpoint was trading right around 1760. The short call at the midpoint was trading right around That means that the net debit, as I mentioned, was $17.10, approximately, rounding off a little bit. I don't remember exactly where that trade was at last week when we pulled up and talked about it, but right around $17.10. That meant our entire risk was $1,710 less commission. Now, nothing's ever meant to be a recommendation on Options Playbook Radio. We were just looking at, well, this is a stock that there's been just as many buy recommendations as there has been sell recommendations, and it's on the lower end of the range actually for the year. And so maybe this is that opportunity. So instead of bottom fishing or waiting for the chart to play out to the perfect moment, let's limit our risk by going deep in the money on a call option, get a lot of stock representation, and as opposed to buying 100 shares of stock at the current price last week of around $97.50, let's buy that option contract and reduce our risk quite a bit and still get an 80 delta, get something that it's going to give you some decent stock price representation. Okay. So Disney went down pretty handedly, but with the rest of the market, I guess this week is the way that you can say it. The markets are really hinging on the CPI data and the Fed speak next week on Tuesday and Wednesday. CPI comes out the morning of Tuesday, and that's the inflationary numbers. And then on Wednesday, the Fed speaks. So I think everybody's just kind of waiting for that. I expect a lot of chop in the marketplace till we get a little bit more clarity on that. But right now, the stock being down $5 over since we talked about it last Wednesday. So what can we do with this trade? So, the fact that it's moved enough, you always kind of want to be right on your forecast, of course, and these are paper trades, but you want to be right on your forecast. But when you're right on your forecast, the opportunity to learn is less. So on Options Playbook Radio, now that we've had a trade that has gone against us, how would we look at adjusting this trade? Okay, so how much did we lose approximately on the option? Well, the stock's down 5. I would expect to lose less than 5, right? Because if I own the stock, I would have lost $5. We bought a derivative of the stock, so we don't expect it to move like the stock. But it had a high delta, so that is going to hurt you. So if I go and look at that option contract right now, which is the 85 strike call, I see that right now it's trading for, at the midpoint, $13.50. All right, we paid $17.63. So in that instance, we are down around $4 on the stock. So we're down over 5. I'm sorry, on the option. We're down over 5 on the stock, and we're down $4 on the option. Right, it kind of makes sense. That's what Delta was telling us. One of the things that does happen, though, when that market goes down and it starts going against you, and we talked a lot about option pricing and, how an option will react, the deep in the money option in particular, when the stock goes up and when it goes down. In this instance, when it goes down, delta goes away. You get less acceleration to the downside than you do to the upside. Trying to say it as many different ways as possible. So yeah, it went down on the first point movement. We would have lost around 80. Delta says that. It would have been a little bit more because it is dynamic in that instance. But right now, I think it's worth pointing out that our 85 strike call option is now trading at a 70 delta. Remember, last week it was at 80. Now it's trading at 70. That means if the stock continues to go down, it goes down another point. Instead of losing 80 cents, we're going to lose around 70 cents. Now, it's a dynamic number, and it's a theoretical number, so I just want to emphasize those 2 points. But this just shows you the dynamics of buying in the money option contracts, and part of the reason why this strategy is popular. Now, if it would have went up 5 points, we would have expected the delta to be around 90, almost the exact opposite of where it is right now. Fairly close. Now, we don't know exactly where it would be. You got other things that can happen. Implied volatility can move, other little things. But just looking at an option chain on a quick movement like this, you see that your option is decelerating. It's acting like less and less shares on the downside. So interesting enough. Okay, so we lost, but we didn't lose as much as if we owned the stock, but we still have a decaying asset. So that's still a battle. And we were concerned about the market. We weren't extremely bullish, so we did sell a call against it, and we sold that 106 strike call. So here is where the maintenance part comes in, or the adjustment. So in this instance, if I run out and I look at that December 16th expiration, and what we sold was the 106 strike call, we see that that is trading for pennies on the dollar right now because the market has moved against it. The December 16th expiration only has 9 days remaining, and now it's trading for 8 cents. So if we're going to stay in this trade, first of all, you could say, well, I'm worried about it. I just want to get out. It's moved against us. And we kind of said that if it got down towards, if the stock got down towards $85 where the strike is at, that is definitely like an out point in our mind because you'd be selling an at the money option contract. And that's where a lot of that premium is at. But if we're still want to stay the course, the fact that we sold this call option has really, saved us. We're up 40 cents. We lost, what was that, $4 on the option, but we made 40 cents on the short option contract. So one thing to do would be, I would definitely close it out. You only have a dime left on it, anything trading for that. And I would think about selling another call against the position. You worry about that when you're rolling down, because you're rolling down and you could peg yourself for a loss in this trade if the market came back too fast. I still would stay fairly close expiration. So we were looking at the December 16th expiration. So that only has 9 days remaining. I'd probably go out only to the December 23rd expiration, and I would roll down and strike because I want to get something for it. So if I go out to that expiration and I look at, and I keep kind of the same course, I could sell the 100 strike for right around 53 to 56 cents. And that's still above where the stock was at when we did the trade. Or, you look at the 97, that's where the stock was at. The 97 is trading for $1.10 by $1.14. So hence we can take a good chunk of that loss out by selling this call option. The only downside is that if it does move against us, it's going the short call option wants the market to stay where it's at or drift lower, right? And long call option wants it to go up. So you're creating this problem, and we did that last week, but if it would have went to 106, we would have been fine. We could have just closed out the trade. We would have did just fine on that trade. So I'm going to sell the 100 strike call. This is going to be our adjustment on that trade. We very rarely go out and just look at a flat-out adjustment, but we would be looking to buy to close the December 16th 106 strike call, and at the same time sell to open the December 23rd 100 strike call, and we'd be doing this for a net credit to the account of around 45 cents, give or take 45 cents. And why not? So we add 1 week onto our covered call position, bring in another 40 some cents to our position, which is a lot relative to the fact that we got into this trade for $17.10 or $1,710 because we used the option instead of buying the stock outright. And we're still within the realm of where this trade has the profitability. We're still higher than where the 100 strike, I should say, is still higher than where the stock was at when we placed that trade. So I'd have no problem doing that. That would be 100% my adjustment on this trade right now, lower my expectations on the profitability of the trade, and be thankful that we did a fig leaf and we didn't just buy that option contract outright. And there you have it. All right. So that's our adjustment from last week. This week, we're going to keep this theme. Year-end stuff is happening. A lot of people like to do maintenance on their portfolio this time of year, and that may mean you just want to either lock in maybe a capital gain, maybe you had some losses and you want to have a capital gain to offset some of those losses, or You want to lock in a loss because you had a lot of capital gains this year, which then if you did, you're doing really well because the market was kind of tough from year to date. So with that said, how could we use option trading to try to enhance that position? So I always like to look at covered call writing at this time of year. And we're just going to do it on a very, very simple stock that is down. It could be on one that's up. It's whatever you look at in your portfolio and decide, I really want to get this sale done on this stock before the year end. And that's going to be our approach on this trade. So if I'm thinking about that, how can I bring in some extra income? Maybe I got a couple of stocks. One of them I want to sell. Maybe if they sell the other one, it's okay. But I like to look at covered call writing as a way to sell those stocks and bring in income above and beyond the sale of the stock. Now, in order to do that, you need to sell the strike price that the stock could trade higher than, right? You want it to sell that strike fairly close to where the stock is at, or even think about selling a strike price or a call option that is in the money. Just because I'm looking to sell the stock, if I sell something that's in the money, that means that the probability of it getting called away is higher. But now I only want to do that if I can bring in excess premium by selling that call option. And there's always a risk. The stock could go down, right, and go way down while I'm waiting for it to get called away. That is definitely a risk, but it's something to consider. A lot of people that do covered call writing are selling calls hoping the stock doesn't get taken away. This is the one time a year where I think covered call writing is very interesting if you really want to sell the stock. So how might that look? Let's go on out and see what has happened in Amazon. So Amazon right now, year to date, is down. I'm going to round off a little bit here, but is down almost 50% year to date. Very close. It's kind of crazy that's where Amazon is at right now. But according to chart on Google Finance, year to date, we're down, 48% if you want to be a little bit more accurate. Okay, so the year end is coming. Maybe I need to take a capital loss in my portfolio, so I'm going to look at trying to close out this position. So if I look at the Ally Invest option chains, I obviously want to pick an expiration for my covered call that expires before the end of the year. There's many different expirations to choose from. You could do the December 30th expiration. I'm going to look at the 23rd expiration, which just gives you a little bit more time in your portfolio, and you're still getting a lot of premium. And this is what I guess I should just take one step back and say one of the things that is interesting about this strategy is that, the VIX is at 22. The VIX really hasn't been below 20 much at all this year. So there's just pumped up volatility in the marketplace overall. And then on individual stocks, we're seeing Amazon right now, that December 23rd expiration, the at-the-money option contract is trading at a 46% implied volatility. The higher the implied volatility, the more opportunity to bring in premium. So the two call options that we're going to look at, and I would, if I really want to get out, Amazon's at 88.46 today. That's where it's trading. I'd think about selling the 88 strike call, which would be 46 cents in the money. Now, if I look over at the put, I only want to do this if there's a good bit of extrinsic value or time value in that option contract. And in our instance, just by looking over at the put option contract, the put is trading for 310 by 325. That gives you an insight into the time value that's in that option contract. So above and beyond the sale, I can bring in another, let's call it $3.20 to my account, approximately. So if I do sell at 88, I get 8 of my sell. Well, and obviously it's a covered call situation, and maybe I should emphasize, I'm assuming you have the stock. Assuming that maybe you bought the stock at the beginning of the year the stock is down, so you have a significant loss in the stock, and you just want to execute that sale to keep it in that tax year, okay? And we don't give tax advice or recommendations. I'm just trying to paint a scenario here. With that said, so I look at selling that. I'm going to bring in an extra $3, if the stock stays where it's at or goes higher and stays above that 88 strike, going all the way out to December 23rd. Now, more likely, most people would maybe sell the 89 strike, and you're getting some good premium on that too. So you're saying if I get up a little bit on Amazon and it goes to 89 from 88.46, I'll make a little bit more profit on Amazon, and I can still sell that option contract for around $3.25. It's really all about how bad you want to sell the stock. Now, if I had just bought Amazon, right, I'd probably be looking at the 94, 95 strike, try to give myself some more upside. But in this scenario, I really want to sell the stock. So I'm selling an at the money or even a little bit in the money option contract to try to pump up some of the income that I can receive from selling that option contract. So interesting time of year to actually look at covered call writing on stocks that you may want to sell in your portfolio. There's no real number here to talk about because we're assuming that you have 100 shares. But you should, if you're thinking about this strategy, obviously you need to have at least 100 shares to sell one option contract. If you have 200 shares, you could sell 2. If you have 300 shares, you could sell 3. So it's a 1-to-1 basis that you're looking to sell that option contract. And just an interesting way to use options to do some year-end maintenance on your portfolio. That's going to be it for this edition of Options Playbook Radio. If you have any questions you'd like to send me, please do it directly at theoptionsguy@invest.ally.com. If you'd like to learn more about what we do here at Options or at Ally Invest in Education, please follow me on Twitter. I tweet about all the events that we do on an education basis here over at Ally Invest. Handle is at Brian Overby, at my name. And that's it for this edition of Options Playbook Radio. Until the next time, may all the options that you bought finish in the money and all the ones that you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.